Howdy, folks. Welcome to Liberty Call. I am Raymond Dahlman, your humble host, and it is Tuesday. Yes, Tuesday, June 18th, 2020. Hope you're having a fantastical day out there in the interwebs. It is a gorgeous day here in Colorado. I know yesterday I said it had been warm the last couple of days. It had been up like 90, and if you don't have air conditioning, it's very unpleasant. So, I mean, it's great down here on the bottom level because, I mean, the ground is like, near the ceiling. So it's very well insulated. Anyways, all right. Hope you're having a fantastical day. God, my beard is just all over the place today. Tried to comb it down, but wearing the earmuffs for meetings makes it just stick out on the sides. Anyways, like I said, hope you're having a great day. And if it is your first time watching the Liberty Call, you in the purple shirt, I see you. If you could give me some thumbs up, a like, a share, subscribe, a follow, and press the notification bell. Kind of a muted day here in the markets. So let's go ahead and jump over, and not quite sure why the little clocks haven't turned red because it is 3 minutes after the close. Let's start out with the Dow Jones. It was up 0.15%, 56 points, closed at 38,834. S&P 500 was up 0.27%, closed at 54,87. The NASDAQ up 0.02, 3 points, closed at 17,860. The VIX was down 3.45% today. It's at 1231. Canada up 0.11%, Brazil up 0.35%, and Mexico up 1 2/3. Pretty good for Mexico. Hey, garbage truck finally decided to show up. I'm glad I get up at the crack of dawn too. Well, I didn't today. It was probably 9:30 before I went out there. But anyways, all right, let's get over to Western Europe. Germany was up 0.31%. The UK up 0.6%. France up 0.76%. The Netherlands up 0.55%, Spain up 0.99%, Italy up 1.24%, Switzerland up 0.3%, and Portugal up 0.78%. Russian exchanges still closed since the 14th. And the overnights, let's see, the Nikkei in Japan was up 0.93%, Australia up 1.01%, New Zealand up 1.03%. In China, the Shanghai was up 0.48%, Shenzhen Component up 0.4%, China A50 down 0.09%, DJ Shanghai up 0.43%, Hang Seng down 0.11%, and the Taiwan weighted up 1.16%. So for most of the markets were in the green. So yeah, let's see. Everything in Europe green. And what was this little country here? Poland was in the red. And only 2 of the Chinese indexes were in the red. So pretty good day across the board. So again, I don't know why everyone's in such a happy mood about the markets. It is pretty ugly out there. If you look under the hood, I mean, you got like 2 squirrels on a treadmill trying to keep up with traffic, but it's doing it for now. It's just I wonder when that stimulus spending is going to finally run out. All right, market recap here. S&P 500 eases from record high, but Nvidia-led strength in tech stifles downside. And I know if you haven't watched it yet, I did covered an article yesterday that talks about how it's more the S&P 5 and then the S&P 495 because those 5 stocks have basically held up the entire market over that time. So go back and watch yesterday's show. All right. On Tuesday, the S&P 500 retreated from recent all-time highs as a NVIDIA-driven surge in tech was overshadowed by consumer data indicating caution. NVIDIA Corporation rose over 3%, making it the most valuable company by market cap at $3.34 trillion, surpassing Microsoft's $3.31 trillion. Excuse me. The surge was driven by a bullish call from Rosenblatt Securities, which raised NVIDIA's price target from $140 to $200, citing strong potential for NVIDIA's software demand complementing its hardware. Let's see. Weak retail sales. U.S. retail sales increased by only 0.1% in May, below the expected 0.3%, and up from a revised 0.2% decline in April. The weaker than expected growth could impact broader economic forecasts and influence the Federal Reserve's decision on potential rate cuts later in the year. Corporate sector movements. Tesla stock fell 1% as the company began its legal battle to reinstate CEO Elon Musk's $56 billion pay package. I think he deserves it. I mean, hell, it's his company. I mean, granted, it's not totally his company. It's owned by all the shareholders. But, he seems to be doing pretty well. I mean, granted, I'm not looking under the hood to see, how everything's being run, but, it seems to be doing all right. Following a shareholder vote in favor of the compensation that a judge had previously voided. So, if the shareholders don't care, why is the state getting involved? All right, Chegg stock, Chegg stock soared 9% after announcing plans to cut 23% of its global workforce as part of a restructuring effort. Lennar stock dropped 3% after the home builder projected lower than expected third quarter home deliveries, indicating sluggish demand due to high mortgage rates. And GameStop continued its decline, falling 2% after CEO Ryan Cohen announced plans to reduce the number of stores. Overall, while Nvidia's success in the tech sector drove some market optimism, broader economic concerns and mixed corporate news contributed to a more cautious outlook for the S&P 500. All right, so that is that. Got a couple of, Got a couple of economic reports from First Trust. First one is for May retail sales. This was written by Nate Gersey, economic analyst there. So let's see what he had to say. All right. Retail sales in the U.S. continue to disappoint, with May marking the second consecutive month of lagging behind consensus expectations. Retail sales declined by 0.3% in May, despite an anticipated gain of 0.3%. Revisions to prior months further accentuated the weak performance, bringing sales down to an annualized rate of 0.1% for the first 5 months of 2024. This decline signals that U.S. consumers are beginning to feel the strain of higher borrowing costs after exhausting savings accumulated during the COVID-19 stimulus period. In May, 8 out of 13 major retail categories experienced growth, led by 0.8% increases in auto sales and non-store retailers such as online and mail order businesses. However, this was offset by decreases in sales at gas stations attributed to falling gas prices. When excluding gas, autos, and building materials, core sales rose by 0.2% but remained flat after accounting for previous downward revisions. Core sales, which are vital for estimating GDP, have shown signs of softening, growing at just 0.1% annualized rate so far this year. Notably, sales at restaurants and bars, a key indicator of service spending, fell by 0.4% in May and have weakened significantly this year, declining at an annualized rate of 2.3% for the first 5 months. This category, which was crucial for the U.S. economy in 2023, will be closely monitored in the coming months. It's essential to consider the impact of inflation on overall spending. While retail sales have increased by 2.3% over the past year, they have not kept pace with inflation. Real inflation-adjusted retail sales have decreased by 0.9% in the last year and have stagnated since peaking in April of 2021. Investors should note that inflation can distort economic data, a scenario not seen in the U.S. for the past 40 years. The view remains that the monetary policy tightening since 2022 will eventually weaken the U.S. economy. All right. So that's that. Got another a report also from First Trust, May industrial production and capacity utilization. This was authored by Bryce Gill. So let's see what's in this report. It's a little bit better news, I think. In May, industrial production in the U.S. exceeded expectations with gains across all major categories, marking the largest overall monthly increase since early 2023. Manufacturing was the primary driver, increasing by 0.9%. Auto production saw a modest rise of 0.6%, while non-auto manufacturing, considered a core measure of industrial production, grew by 0.9%. A notable bright spot within manufacturing has been the production of high-tech equipment, which has increased by 8.2% over the past year. This growth, the strongest among major categories, is likely driven by investments in artificial intelligence and the reshoring of semiconductor production. However, the sector's activity has begun to slow, with May showing a minimal gain of just 0.1%. This slowdown suggests that the initial surge of activity prompted by the CHIPS Act might be tapering off. The mining sector also contributed positively in May, with activity rising by 0.3%. This increase was primarily due to gains in oil and gas production, which more than compensated for a slowdown in new well drilling. Additionally, the utility sector, known for its volatility and weather dependency, showed significant strength, increasing by 1.7% in May. Complementing the industrial production data, the Empire State Index, which measures factory sentiment in New York, improved to a reading of negative 0.6 in June from a negative 15.6 in May. So, hey, there's some improvement. Although it's still in negative territory, this improvement indicates a less severe contraction in factory activity. Overall, May's industrial production highlights a robust performance across various sectors driven by manufacturing and high-tech equipment production. However, signs of slowing activity in certain areas suggest that some of the recent growth drivers may be losing momentum. All right, so the first article or the first data report, not good. Second one was kind of okay, but it is slowing down. So again, take whatever measures you need to out there, folks. All right, one last article from Zero Hedge titled Why Consumer Sentiment Fell to a 7-Month Low, and this was written by Daniel Lacal. So let's finish up the session with this one. All right, in June, the University of Michigan's Consumer Sentiment Survey dropped to its lowest level in 7 months, registering a 65.6 down from 69.1 in May and below the expected 72. This decline was seen in both current conditions and expectations category. Year-ahead inflation expectations remained at 3.3%, so basically where we're at right now, higher than the pre-pandemic range of 2.3 to 3%, and long-term inflation expectations rose to 3.1%, above the pre-pandemic range of 2.2 to 2.6. And let me stop. I know I covered an article in the last week or so where they're talking about raising the Fed's target goal from 2% to 3% because that's where we've kind of gotten stuck. So if you can't fix the problem, let's just change the rules of how it's measured. All right. President Joe Biden's optimistic portrayal of inflation data on social media contrasted with the reality felt by consumers who experienced significant increases in services, shelter, and electricity costs. The perception that inflation should have been lower months ago, closer to 2%, highlights the ongoing economic strain. The Inflation Reduction Act is criticized for perpetuating inflation due to aggressive fiscal policies that undermine the Federal Reserve's monetary tightening efforts. Yeah, all that federal spending, all it did was just make it worse. I mean, seriously, folks. This has resulted in a persistent federal deficit fueling inflation, preventing CPI from reaching its lower target levels. Neo-Keynesians argue that the gradual disinflation without a recession and low unemployment represents a successful soft landing. I would disagree. However, critics contend that this approach has slowed economic recovery, kept real wage gain growth stagnant, reduced purchasing power, and increased debt burdens. Yeah, because that's good. Government spending is blamed for excessive deficits, higher taxes, ongoing inflation, and weakened productivity growth. Key economic indicators such as labor participation rates and employment to population ratios remain below pre-pandemic levels, and real wage growth has been nearly flat. Consumers have taken on more debt, with credit card debt hitting record levels, indicating an economy under strain. The economy's weakening amid fiscal expansion and rising debt is concerning. With interest expenses reaching new highs, critics argue that Keynesian policies have harmed the private sector. Again, I would agree with that, especially small and medium-sized businesses, leading to discontent among families and small businesses who face high taxes, inflation, and stagnant wages. Despite claims that negative social media sentiment skews consumer confidence, the survey's high levels in 2019 amid media negativity suggests that inflation and higher taxes are more substantial factors. This discrepancy between GDP and GDI, which is GDP is gross domestic product, GDI is gross domestic income, unemployment rates, labor force participation, and real versus nominal wages reveal deeper economic issues. Bloating GDP with debt, critics warn, will ultimately lead to adverse outcomes. I agree. And I just, in a meeting earlier with a good friend of mine, we were talking about, the economy, the state of things, and just the volatility we've gone through over the past few years, and it's kind of I pose this to a lot of folks, clients, prospects, and such, and it's like, well, in the summer of 2020, before we had done any of that stimulus spending, and just all we had the crazy shutdown and all that nonsense, but we haven't spent any money yet. And the market was teetering. And, well, actually, the market was teetering back in, I guess, April. when they started talking about, well, we're going to come to the rescue with a rescue package, and the market just went crazy up. And I had no idea. I didn't think that they were going to print, what was it, $4 or $5 trillion. I mean, basically increase the money supply by 40%. And, the question I pose to people is, if we could go back in time and do nothing as far as monetary stimulus and just, ridden the economy through whatever downturn we were headed into at that point, instead of repapering over the economy. And, I have my own speculation on why they did that. Was it to get Trump reelected? I don't know. And then they just spend more money after, Biden came into office. So they're both guilty of it. The inflation fault rests on both their shoulders, in my opinion. But if we could have gone through that entire market cycle where, the market went down, who knows where it would have bottomed out. The Dow was like, 25, 30,000 at its peak at that time. And if it had gone down to, 15 or 12, hey, it may have taken a couple of years to get back to break even, but I would have much rather gone through that downturn because I was prepared for it, from a portfolio perspective. And then, just ridden the rally back up. But no, the government had to step in, dump all this money into the economy, overinflate the markets when most of us, portfolio managers were prepared for a downturn. We weren't prepared for another rally. So anyways, it's been a gigantic mess the last 3 or 4 years. And, when it's all said and done, your groceries are 40% more expensive today than they were 4 years ago. So anyways, all right. So, there's my soapbox about government intervention. So, all right. Well, that's everything I had for today. If anyone needs anything from me, please go to DSAFinancialGroup.com. All my contact information's there. I hope you have a wonderful evening, and I shall talk to you again next time. Adios.